Everyone. Good evening from my side. This is 𝒊𝒏𝒂𝒏𝒄𝒊𝒂𝒍 associated with World Academy, welcoming all of you for the webinar on financial risk management. We have our designated resource person with us. I will take a couple of minutes before starting the main session, and I will be hand over to our respective trainer for the session. So today's webinar is hosted by World Academy for Research and Development, an UK-based organization. Our motto is shaping expertise, nurturing ambitions, and elevate your potential. So World Academy is always beside the professionals to enhance the capability or the credibility of the professionals for their global career. We are ISO certified organization. We have a couple of ISO certification for our quality management system and quality education system. And that is the global affiliation of World Academy. So we are offering programs in 61 countries. So that means we are covering 61 countries right at this moment. We're the member of American Accreditation Association. We're the approved center by Cambridge Academy of Professional, which is a UK-based organization. Approved center by Prof. Qual and approved center by Board of HR Certification. We are the approved provider of HR, CIS, HRM, and HED USA, which all are the HR Certification Institute. Approved provider of HR, SHRM academically aligned institute, one of the very prestigious recognition for World Academy. We are the SHRM academically aligned institute for our PGD HRM course. We are accredited institute by International Professional Accreditation Council, which is a Singapore-based organization again. And we are the member for CPD Certification Service, which is UK-based certification awarding body. We're the partner for Singapore Training and Development Association, partner of Institute of KPA Specialists, and partner of Academy of Business English and Communication. So that is the global affiliation for World Academy. And a couple of courses we are going to launch in this month and the coming months. So let me have a look on this. The first thing, we are going to launch a Certified Financial Risk Manager. So one of the very, very prominent and unique course. And you will be wondering to know that Dr. Simon Fahmy is the one and only resource person for this course. The module will be Introduction to Financial Risk Management, Market Risk, Credit Risk, Liquidity Risk, Operational Risk, Enterprise Risk Management, Regulatory and Compliance Risk, Financial Risk in Investment Management. So you can see that in today's world, where every institute, every financial institution, every individuals are very much worried about the non-regulatory financial transactions, financial fraud, etc., etc. So financial risk management is one of the very important area for this concern. That's why World Academy is going to launch a very time-demanded course, Certified Financial Risk Manager, which will be covering all these 8 modules. The very, very, practical-oriented modules will be covered. And apart from that, there are Certified Project Finance Analyst and Labor Law for Bangladeshi participants only. Then also Monitoring, Evaluation, Accountability and Learning Diploma Program. Then we have HR Business Partner 2.0. We have Occupational Safety and Health, PGD in Occupational Safety and Health. We have PGD in Human Resource Management. We have a Risk Management Professional, Certified Risk. That is a type of project risk. And also Certified Finance and Accounting Professional. So these are a couple of courses we are going to start in coming weeks and months. Certified Learning and Development Professional and ISO certification, ISO Lead Auditor course. Result-based monitoring and evaluation and anti-money laundering specialist. This is also a very important course which will be launching in 26th of October. So that's about from my side. Once again, I'm welcoming all of you for this webinar, the free webinar on financial risk management. We have our resource person today, Dr. Simon. So he will be from UK. So he will be discussing for the next 1 hour, 45 minutes time. Dr. Simon. Can you? Okay.
Yeah. Good. Yeah. Good afternoon, everyone. Yeah. As I've been introduced, my name is Simeon Fayemi, and just a little bit about myself before we continue. I'm a PhD holder in accounting. I'm a fellow of ACCA, and I'm a fellow of ICANN. That's why we have FCA and FCCA. And I have both academic and industry experience in terms of what I've done over the years. I've managed risk at different levels myself, and I've done quite a lot of work in the area of banking and financial services as a whole. So I know a bit about the challenges and the risks facing financial services. And that's one of the reasons why we're here this afternoon. This is just like a tester of what to expect. This is just like a seminar to give us an overview of what we should be expecting from risk management perspective. So that's why we are here this afternoon. I won't want to take much of your time about myself because in terms of work, I've worked in quite a number of institutions like Barclays, Royal Bank of Scotland, Bank of America, Bank of Africa, and others. But I won't want to bother you with that. Let's go straight to the point, which is an overview of financial risk management. Now, the question is, why are we looking at this? What is financial risk management itself? And from what Basel Committee 2001 rather described or defined, it looked at financial risk from 4 major perspectives. One, that's your ability to identify risks and categorize them into different areas. Is it market risk, credit risk, operational risk, and other types of risk? Now, having identified this risk, how are you assessing it? That's when it's talking about another side to it, the assessment of such risk, which is the second bit. Then from there, we move to how do you mitigate or manage these risks? Now,
can you go with the slideshow mode?
Yeah, I'm going to. Yeah, something is blocking it, but I'm still with this. Something is blocking the slide. Can you see the slide now?
We can see, but if you just click on the slideshow mode, then it will be much more easier. At the top, there is a slideshow. At the top, top left side corner.
Okay, all right. Can you see? No. Slide.
In the menu bar, you can see at the top that home, insert, design, animation, and slideshow. Click on that.
Slideshow, maybe. No, I changed my system shortly before. It's slide control. I have slide control. Yeah. No. Unfortunately, I don't have it on this one because I changed the system. But let me try. So you cannot see the slide.
You can continue. We can see that. We can see that. No problem. Go ahead.
Okay. Let's just make use of it for now. Okay. Now, as I was saying, you are looking at identifying the risk. You are assessing the risk. Then what you do, you want to mitigate against the risk. That's what we talk about, controlling that risk before it becomes a problem. Then from there, you talk about after you have put in measures to control, you have to monitor those measures to ensure that they are working. Because it's not enough for you to say, okay, I'm controlling, I'm managing my risk. Then you are not monitoring the performance of those controls you have put in place. So you have to monitor it. So that's how Basel discussed or described what financial risk is all about. Now, looking at it, I've just summarized it in the other side, which says it's just like we are trying to, is the process of identifying and managing risk. That's what we call financial risk management, just to give a flavor of what it's all about in summary. Now, moving from there, why are we interested in financial risk management? Why? Why are we people, why is everyone talking about financial risk management? Why has it become a major topic of the day? Why is everybody concerned about risk management? There are some reasons which we are discussing, and why we have this over the years with globalization. Things have moved. There has been a sort of deregulation within financial market where people can trade in different types of products, where banks or financial services industry have moved away from their conventional products. They have this global market where they can trade in. They have deregulated products, and all these have increased associated risks. Because of this deregulation, you can be in UK and be trading in Singapore. You can be in UK and be trading in Africa. You can be trading in America. You can be trading all over the world. So that deregulation and globalization have increased associated risks in the market. And because of that, we need to do more about how we manage risks that will arise from such business activities or transactions. So now, risk management before used to be, okay, analysis of your credits. Just identify your risks, and what do? Then you just insure against them. Okay, let me just take out insurance to cover my risks. But now it has gone beyond that. It has gone to a level of complex financial and economic models, because there are a lot of uncertainties all over the world, as a result of which we need to do more to guide our money, to guide customers' money. And as a result of that, you can see that there are a lot of products now, exotic products, over-the-night transactions, repo, reverse repo, you have future transactions, you have options, you have mentioned it. You have different types of transactions that financial industry can venture into now. And all this, we need or we require different types of risk management, because things have now moved from product-based to rule-based. And another issue is the fact that we have different regulations governing different environments. Like in the UK, we have FCA, we have PRA guiding the way transactions are managed. Go to America, you have their own regulatory authorities. Go to France, the same thing. Singapore, the same thing. Bangladesh, the same thing. They have different regulatory authorities managing or overseeing the financial transactions. And we have to comply with the local regulations. As a result of which, we have to have a sort of robust risk management framework in place. Those are the things that have led to increased awareness about risk management. Now, from there, let us look at the kind of risks we could have in any organization or any environment. Hope I'm not moving too fast. Okay, let's move to what I call taxonomy of risks. Now, here we are looking at different types of risks that you could face as an organization. Looking at them, we start with what we call credit risk, which is a risk that could come from an obligor or a counterparty having difficulties in fulfilling their contracts, where the counterparty may not have enough money to meet up with the agreed terms of their contract. Payments have been agreed and the date has been agreed. But now you have a situation where an obligor or a counterparty is failing to fulfill his or own side of the contract. So, and that includes counterparty risk, maybe settlement risk, or it could be from our end as a financial institution where we have concentration risk. For example, concentration risk means maybe you have concentrated your credit on a particular sector of the economy or a particular region within the population that you are giving your credit to or you are giving loans to. In that wise, you may not be able, there may be a problem if there is over concentration and you have failure from that end. So that's concentration. Settlement risk, that is inability to settle when the day or the time arises. Or, as I've mentioned, the obligor or counterparty risk, where a third party or a fourth party failed, and that has now led to a major failure within the financial life cycle. Now, the second one is market risk. Market risk, as the name suggests, is any risk that could be identified with the market activities. Fluctuations in the value or in income or from tradable assets. Maybe you have traded an asset and suddenly the value has decreased, especially with different types of products like derivatives that we are dealing with. Maybe the prices have gone down, the prices of your bonds, of your equities, of commodities. It could be any product. The market value could change due to many reasons. For example, during COVID, prices of many products were at bottom level. Things went down, really. They worth little or nothing. Then, so it could be your portfolio. It could be that market prices or market indices have affected your portfolio performance because of it could be for any reason. For example, it could be that your equity prices have gone down. It could be that your foreign exchange rates have been impacted. It could be that interest rates have changed. For example, during the week, Federal Reserve reduced interest rates in America. On Thursday here, Bank of England retained the existing rates. All those fluctuations will affect the value of equity or the value of your assets. So you have to guard against all this? That's what we call market risk. Don't let me take much of our time on that. Then we have operational risk, which could be a risk associated with failure of our internal processes. It could be failure from system, IT, it could be from people, and it could be from external events like earthquake or anything. So that's the operational impact on the activities of the business. Then we have currency risk, of course. That one is very simple. That has to do with fluctuation in exchange rates, especially for people that deal in products such as spots, forward contracts, future contracts, derivatives of any sort. Currency risk, currency exchange movement will affect it. Then we look at liquidity risk, which is a risk that you may not have enough to meet your needs, your financial obligations. That's the liquidity. That if you are not solvent enough, you don't have enough cash or money in place to meet your daily or your financial obligations as at when they arise. That is a liquidity risk. Then business risk on its own is a risk that could be associated with management's inappropriate decision. Especially when the management of an organization fail to take decisions in the interest or in the long-term interest of the organization that will affect the final outcome of that organization's performance. That's what we are saying here. The performance of the organization could change because of inappropriate decisions from the top management. And unfortunately, business risk has increased as a result of a lot of mergers, acquisitions, deregulation that we have talked about that have taken place all over the world, because we have many companies coming together, merging together. You have companies acquiring another one. You have all of them. You have banks acquiring banks coming together, and things like that. So it means business risk have changed. It has increased in why. So that is business risk on the financial services. Then we have compliance risk. Compliance risk is a risk that you will flout the rule. That is, it's a risk that there be a violation of laws, of regulations, and industry standards. And when it happens, we all know the implication. It comes with sanctions if you violate rules. And we've been seeing a lot of, oh, this bank has been fined, that insurance company has been fined, that company has been fined because of violation of simple laws and regulations all over the place. That is what we call the taxonomy of risk. Okay. Now, from there, let us look at something different: risk management framework. Risk management framework. We are looking at the framework or the process we put in place to manage risks majorly. And it depends on each organization. But from my own perspective, which is in line with industrial standard, it is believed that each organization should have what we call the 3 lines of defense. 3 lines of defense in managing risks. And that has been seen as a very good governance model. And when we talk of 3 lines of defense, let me explain it quickly. Looking at an organization, I'm looking at, let's say a bank or any organization whatsoever, there are 3 major areas of managing a particular transaction. We have the processing, we have the recording, and we have the review. The processing is the first line of defense. That is, for example, let's take a bank, for example, that's when you have people that will process a transaction. They will do due diligence. They will ensure that they are dealing with the right person. Then they will accept the transaction from that particular customer. Then from there, it goes to finance, which is the second line of defense, who will record these transactions and ensure there's accuracy, and completeness in what they are recording. They must ensure that there's accuracy and there's completeness. The essence of this is to ensure that if the first line of defense has missed something, the second line of defense must be able to identify it, and that is finance department. Now, Going from there, you have the third line of defense, and that is where you have the internal audit, you have the risk department, you have the compliance department. They are the third line of defense, ensuring that if anything has escaped, these first two lines of defense, at least the third line of defense, will be able to identify it and manage it. So that is a sort of framework that is expected to be in place in every organization. Now, moving from there, we have Basel. We are all aware of the Basel Accord, which has been like a supervisory framework for especially financial services industry in terms of managing risk. And when it started with credit risk management in the banking books, which was just a way of analyzing your risk. Oh, how is it? This is 30 days, 90 days, over 90 days, and the like. So at that point, the complexity in terms of transactions were not in place. The complexities were not there then. But when the complexities increased, then Basel II and Basel III came into being. And now that's when you look at how risks are being managed now, emphasis are now more on liquidity and capital. And that's why each organization is meant to calculate what is called CAR, that is capital adequacy ratio, almost on a daily basis now, and get it reported. Then you have to calculate liquidity coverage ratio. That is, you are trying to test your capital adequacy, how your capital is able to meet up with your transactions, and how you're able to protect the interest of the stakeholders, especially the depositors. Then, from liquidity perspective, we are looking at how easy is it for you to be able to turn around, to be able to meet up with your transactions when they are needed. How you are able to get enough cash or adequate cash to meet your transactions when the need arises. So all those things are now in place. And we know we have Basel II, Basel III, but Basel 3.1 is going to come into effect from early next year. So because they are improving and updating all this risk management framework from different perspectives and continuously. And now, another thing we are saying here is that senior managers must continuously manage risk on consolidated basis going forward. That is, you must not look at that one aspect of risk. You must look at all aspects of risk. That is, as you are looking at liquidity, you are looking at your capital, you are looking at the operational, you are looking at the exchange rate, you are looking at everything as a whole. So you are looking at it from a holistic approach as one thing that must be dealt with at the same time. You are not just looking at one aspect and closing your eyes to the other aspect, which will bite you if care is not taken. So everything must be taken together holistically in managing risk. Okay. Then, as I've said, today is just like an overview. So that if I'm not going into details, don't mind me. When we move fully into risk management, we understand more. Now, risk assessment. How do we assess risk? How do we measure risk? When we say there are risks, at the end, how do you know there is a risk in an organization and how do you manage it? So how do you assess it? So now, firm-wide risk assessment majorly, they are linked to solvency and majorly capitalization. That is, you are looking at how solvent an organization is from time to time. That's what will determine whether an organization is struggling or not. And in that way, we have a lot of calculations to do, which we will not be able to do now, but we have some minimum regulatory requirements that must be met. Like, don't let me go into that, but at least the capital requirement now in the UK, for example, is about 15.1. The car must be 100%. At least your SCR, you must be able to cover the transactions 100%. That's the minimum requirement that is expected. Now, then, what this is talking about is that before they become issues, you must be able to identify them on time. For example, if your capital adequacy ratio falls below the minimum, then it means there's a problem. And like in the UK, you must report it the same day to Bank of England, PRA. Okay? If your liquidity coverage ratio, LCR, falls below 100%, in most cases, they recommend 100%, but it is expected that you maintain like 110, 120% as the case may be. If it falls below that, then you must report. Now, another thing is we have what is called rating agencies. Rating agencies like Standard & Poor's, Fitch Rating, and the like. They have a sort of how products, how organizations, how sovereigns are rated and graded. Now, it is expected that in taking your decision, when we look at credit rating later, we look at that adequately. You must be able to put them in perspective when in taking a decision. For example, if I want to give money, if you want to give money to an entity, to a country, for example, a sovereign, what are the things you consider? Is each AAA rating? Is it B? Is the company BB, BBB? Is it A+, A-? Those are the things you consider when you are doing that. So in looking at when you are managing your risk, when you are assessing your risk, you want to know who have you given money to, who are you going to give money to. So those are the things you must consider in taking your decisions. Then, as I've said, capitalization is one of the major issues that a firm must consider. How capitalized are you? Are you well capitalized? Are you undercapitalized? You can never be overcapitalized. Though you can be overcapitalized if you are tying down your capital without using it for any productive transactions. But in most cases, it is expected that you must maintain a certain capital level, a certain capitalization level that is expected of your company, within which you will not be going against the regulatory requirements. But the essence of it is for you to stay within the regulatory framework that says, okay, your capital adequacy must be this level, your liquidity ratio must be this level. And also, because we are in an uncertain environment, risk assessment must be holistic, as I've said. So, and that's why for years now, it has been a major area of research. People have been researching what is the best way of managing. And it has been concluded, although people are still researching, that there's no one best way of doing all this. But what is important is for you to have a framework of risk assessment that will cover every area of your risk. It will cover every risk, and it must take into consideration regulatory requirements. Okay, Let's move, because of our time, move quickly to another aspect, which is risk management process. Risk management process is just a process of systematic strategy that assists organizations in managing their risk. When we say risk management process, it's a process of managing your risk, nothing more than that. And there are 5 steps involved. We have risk identification. That is at the point where you try to find out if you are having issues. What are the risks facing you? Is it operational? Is it credit? Is it market? Is it currency? Now, having identified the kind of risks you are facing, then you want to analyze it using different methodologies. So to analyze the risk into, when you analyze them, it could be that they are high, low, or medium. Depends on the potency of that risk at that particular point in time. So you want to know which area, which level they belong to, so that it will help you in taking your next decision, which is prioritizing that risk. Okay, if it's a small risk that an employee is sick, well, that's not a big risk. You can say, okay, if it's not, though that's operational risk that somebody is sick and will not do his work, but that's not as bad as one of your debtors not paying, one of the obligors not paying. Because when you are prioritizing this, you want to know which one is more important that you should put more effort on. If a staff is sick, another person can cover. But if someone fails to pay, it means there's a problem. It's possible that person is facing liquidity problem and is unable to pay, meaning that it's going to deplete. When you are doing your own, following your IFRS, for example, it means there's a problem. When you are calculating your expected credit ratio, credit loss ratio. So all those things, then after you have prioritized it into high, medium, low, then you want to, okay, how do I mitigate against it? Then you want to think about how you mitigate against this risk. Okay, what do I need to do now? Okay, because this person is because I'm having my LCR has fallen below a certain level, then I need to report myself to the regulatory authorities. I need to take this action. I need to go to court. I need to do this. I need to do this. Then, if, for example, it has to do with me having a spot product, I can do a future product where we will have agreed on the price today so that fluctuation will not affect me. So there are many things you can do to cover what you want to do. So then, as I've said earlier, it's not enough to provide solutions for problems. You have to monitor it to ensure that they are working. That's where monitoring comes to play. Now, let's look at roles of a financial risk manager. In financial risk management, that's your own role as a financial risk manager. What do you need to do? One, you have to establish the process of risk management. It's that holistic approach of how the organization should identify, analyze, prioritize, and manage risk. You must establish that process. Then, two, you must make recommendations on how to control risk factors. You want to know what are the factors causing risk? Why are we having these problems? You have to make recommendations in terms of looking at the problem and the solution. What do we need to do? Now, also, you need to work with various teams to calculate risks. I mean, you have to work with different people, which follows the next factor we are looking at, liaising with different stakeholders across the business, discussing with the board, advising the board in terms of how you think risk should be done, what is causing risk, and what do you think from your own perspective, how they should be managed. What's it that is triggering it? You want to look at the factor that has triggered risk in the past, then have to analyze it. What can it cause another problem or another risk in future? Then those are the things you have to consider before you go to the board. Then you can forecast and analyze the trends in the market. But that's very key. As a risk manager, you must be able to forecast trends. That is what's going to happen in the next 5 months, the next 6 months, in the next 12 months. You want to look at all those. Then you want to conduct research and analysis to assess the extent of the risk. That is, this risk in particular, what's the level of potency? How bad it is? Or is it something minor, something that can easily be resolved? Or is it something that is biting that we need to do more? Then you want to develop different models and plans to deal with potential risks as a risk manager. Then you want to utilize financial and statistical tools and software to appraise risk. Then, lastly, you present the results of your findings to appropriate stakeholders with recommendations. These are the things you need to do as a risk manager. Because of our time, that's why I'm trying to just move a bit. The next thing we are looking at is risk management tools and techniques. We have different ways, different tools you can use as a manager. You can use what's called value at risk software. There's a software for that can calculate all these things for you. You can have probability and impact matrix. You can have risk adjustment capital model. We have risk data quality assessment. You can have risk maps. You can have risk identification process, which is also a tool. We have SWOT analysis, that's strength, weakness, opportunities, and threats. You can do there's analysis you can do on that on SWOT too. You need to keep risk register. You have to do what is called risk root cause analysis. That is, want to go deeper to find out what has been causing this. Then you do we have decision making, which you can use. There's a tool, decision making tool, risk assessment, acceptance tools, risk reporting frameworks. There are many things you can do. Another method is brainstorming, where you bring all managers together, all stakeholders together. You sit down and try to find out what are the main causes of risks, what are the root causes, and what you analyze it together. You prefer solutions, and like that. Then, lastly, is risk monitoring. There's a tool for monitoring risk. Like in some organizations, every morning, you look at the risk and issue log, which one has gone, which one remains, what has been resolved. So that there are many tools you can use to manage and monitor risk. So I think we have risk control, which is all we have been discussing all this far, in terms of technological things that have changed. What has changed? We have regulatory and technological changes. Those are the things that have increased the accuracy of risk management. And one of the things now is that this AI, that's artificial intelligence, is helping. It can help us to identify risk on time. I don't know how far that one is through, but at least it's early days. So many things can be done. We have real-time monitoring. Traders are where you immediately identify problems, inform your traders. Oh, there's a problem with this trade you just processed. Let us reverse it. Let's use this, do that. So with real-time assessment of risk and management of risk, a lot can be done to save us from financial embarrassments and also from getting things wrong. So those are the things we can look at. That's risk control, basically. And lastly, is it lastly? Yeah, almost. Yeah, what are the ethical considerations in financial risk management? The ethical considerations, one, for risk management to be effective, or financial risk management to be effective, there must be support of the top management. How are they viewing it? That's why what we call tone at the top. How do they see it? Are they supporting the finance risk manager? Are they supporting him? or they are just turning blind eye to it as if nothing happens. So there must be management support, top management support before risk management can be effective. Then, two, we must manage our blind spots. Blind spots must be managed. Like the other time we are talking about traders. Trading is like a blind spot because you can get it wrong, you can get it right within minutes. And you can lose millions within minutes, and you can gain millions within minutes. So in that wise, that's a blind spot. We have to manage it more effectively. There, you must improve the level of risk awareness, codes of conduct, and value system. That is, people must be aware that they need to be more conscious about risk, and they need to do more to ensure that risks are managed effectively. They must conduct themselves in a way that will not be detrimental to the organizational objectives. And the value system must be there in terms of everybody being carried along. That, okay, this is the value of this organization. We manage risk effectively, and we want all hands on deck to ensure that everyone is there. Then we have to prevent ethical lapses. And I technically put this 𝒊𝒏𝒂𝒏𝒂𝒍 issue there. We remember when somebody was just rounding all the points in different accounts. At the end of the day, he got millions, got away with millions. That is when we say 10 pounds, 20 pence, 1 pound, 2 pence. He just, all those pence, this guy just added them together, and it became a lot of money. So we don't want such to happen. And also, staff must be well remunerated. There must not be poor incentive for staff. They must be well supported financially and otherwise. Now, another thing that must be done is there must be transparency and accountability. And that one must start from the top management. There must be transparency, accountability, and everyone must buy into it in the organization. Then, there must be consistency in the way we look at risk management. It won't be that one department is saying this, another department is saying that. There must be consistency in the approach. Risk department will not be saying this, compliance department will not be saying another thing, finance will not be saying that. So everybody must be saying the same thing. There must be consistency in the way we apply risk management techniques and process. Now, the last thing is the emerging trends in risk management. As I mentioned earlier, now with the advanced technologies, we have artificial intelligence that will help in terms of identifying risk earlier than expected. A lot of technological processes are being put in place that will help us to identify risk and manage them. A lot of data analytics. People are now employing data analysts to look into data and advise them based on the maybe sequence of things or how things are being managed. We have another thing is the cyber security risks, which everyone is aware of, with things like data breaches, ransomware attack, and phishing scams. All these are new things coming into. These are part of the emerging trends in risk management. Then another thing is incorporation of global risk management into the overall risk management strategy. We are saying that organizations must look at what is called the generally accepted global risk management and incorporate it into their own risk management strategy. They must have this done immediately. And lastly, we are looking at enterprise-wide risk management. That is risk management at all levels, not only in finance, not only from the front office perspective or back office perspective. It must be all inclusive, and it must cover all areas of the organization. I will stop here because this is just a short seminar on risk management. Thank you all. Questions? If you have any question, sorry?
Okay. If anyone having any question, you can raise hand, so we can allow you to ask the question. I think there is no other question from anyone else. Is that
Okay,
correct?
no question. Okay.
No questions, sir.
Perfect.
Thank you. Thank you.
So, all right. Thank you very much, sir, for your time with your VG schedule, and hopefully it will be a very good session with all of our delegates coming from different countries. So, I'm sure that they got some insights from the entire topic, though the topic is very vast, but we have only around 45 minutes time to facilitate this part. But meanwhile, what I was continuously there in the session, and I'm sure that everybody will get the insights. And of course, yes, we will share the certificates. So the email, those who have joined, we will get it from the Zoom, the part attendance list, and we will share the certificates through there. No worries about it. Emmanuel, you have question? Please unmute yourself and ask the question. Ben?
Yes, I have a question.
Yes, please. James.
Yes, how much is the cost for the certified certificate? If someone to study, and then how long it takes, the duration?
Dr. Simon.
Yes, I'm with you.
James, can you please ask the question again?
I said how much is the fees for studying the certified course in certificate? Then how long it takes? The duration, is it 2 years, 1 year?
Are you asking for the course? How long it is?
Yeah,
Yes,
how long are the costs?
The
Yes,
course will be for 4 months long. Certified risk management, the financial risk manager. That is 4 months long course.
How much is the money?
The total fee is $460.
Okay.
Okay.
Is there any PGD?
No, there is no PGD right at this moment.
Okay, thank you.
So that colleague, let's talk to this man quick, yeah.
All right. So if you don't have any other question, you can conclude it here today. Thank you, Dr. Simon, for your wonderful presentation with us. And thank you very much for all the delegates. Emmanuel, are you asking anything to us?
Excuse me, can we get any slides?
Let me ask the trainer, and then we will let you know. If he's sharing the slides with us, then we will share through the email.
Yes, thank you, sir.
Thank you. Okay. So thank you once again, Dr. Simon.
Thank you. Thank you all.
Emmanuel, are you asking
Thank you,
anything
sir.
to
Thank
us?
Thank you.
Are you asking anything, Emmanuel? No. All right. So thank you once again. Thank you, sir. Thank you all the delegates for your patience listening with us. And of course, we'll be looking forward to have you again in other sessions as well. Peter, the time is over, so we need to close it here. Thank you very much for your presence.